Hello everyone, this is Dr. Carl Letamendi, and this is a video presentation of the Chapter 1 lecture titled Personal Financial Planning. So there are multiple chapter objectives in this particular chapter. The first one is you'll be able to list individual factors that strongly influence financial thinking. Discuss how income needs, risk tolerance, and wealth are affected by those individual factors. Explain how life stages affect financial decision making. Discuss the basis of sound financial planning. Identify the systemic or macro factors that affect personal financial planning, and these are factors that we don't have any control over as individuals. Describe the impact of inflation or deflation on disposable income, or as a lot of other texts call it, discretionary income. Describe the effect of rising unemployment on disposable or discretionary income. Explain how economic indicators have an impact on your own personal finances. Trace the steps of the financial planning process and explain why that process needs to be repeated over time. Characterize effective goals and differentiate goals in terms of timing. Explain and illustrate the relationship among costs, benefits, and risks. Analyze cases of financial decision making by applying the planning process. Identify the professions of financial advisors and also their specific designations and a little bit about what they have to go through in order to get certain designations. Discuss how training and compensation may affect your choice of advisor if you feel you need an advisor. Describe the differences between objective and subjective advice and how they may affect your choice of advisor. And lastly, discuss how the kind of advice you need may affect your choice of advisor. So there are essentially 4 micro factors that affect our financial thinking. The first of which is the family structure. The second is health, career choice, and our age. So for family structure and health, these are 2 particular factors that are going to impact our income needs and our risk tolerance. Health is going to again affect your earnings and also create expenses if you're not in good health. Your career choice is going to influence your earnings potential, and your age determines your life stage. So essentially here we have 1, 2, 3, 4 stages. During your young adulthood, your source of income are your wages, your wages or your salaries from our jobs. We're not expected to have an asset base right now. The expenses are typically low, your risk ability is low, and your risk willingness is high. During your middle adulthood, it changes a little bit. Your sources of income are should be a combination of wages and investment. Your asset base is accumulating. Your expenses are growing. Your risk ability is a little higher because you have more leverage to take certain risks, certain investment risks. And your risk willingness, however, is a little lower because you don't want to lose what you have. In your older adulthood, or the last third of your career, the sources of income, just like in middle adulthood, are a combination of wages and investment. The asset base is growing. Expenses are also growing. Your risk ability is a little higher because you can afford to take risks. And your risk willingness is a little lower again because you don't want to lose the assets that you have. During retirement, you're not earning any wages anymore because you're not working any longer. So your source of income are investments, or you can continue to work. We know people well off into their 60s and 70s who are still champs and still working at an older age. Your asset base is being used up because now you've developed this bucket that you've established throughout your whole life working, and now you're using up what you've established during your wage years. Your expenses are low, your risk ability is a little higher, and your risk willingness is low. In addition to the micro factors that affect our financial thinking, we also have macro factors. These are things that we don't have much control over. And we start with business cycles, which has periods of expansion and contraction. Business cycles include periods of expansion and contraction, including recessions, and they're measured by the economy's productivity. So you can have your own individual productivity as an employee, for example. So we can also measure the productivity of a country based on its gross domestic product. So that's in aggregate how much everyone has produced in that country. So production is important. A little bit deeper as far as gross domestic product is concerned, this is a chart reflecting the GDP percent change based on current dollars. So we kind of go back into history into the 30s, and we can see that it starts that GDP declines. These are the post recession years here, and then it picks up again, and then it drops again. And now we see that it increases a little bit better, and then eventually it kind of starts to stabilize somewhere after the 80s up until now. And if this chart continued a little further into 2008, 2009, what would we expect? The real estate collapse and another period of low gross domestic product. But this is basically a snapshot of the business cycle as it relates to gross domestic product. When it comes to employment, you have the macro variables of frictional, structural, and cyclical factors that impact employment. These are the cyclical effects. During a boom, an economic boom, the rate of GDP is unsustainably high, and the rate of unemployment is unsustainably low. So this is as close as zero unemployment as you can get, which is presumably good. But if you go back into history, a period of massive boom usually follows a subsequent collapse, and then that's when unemployment starts to increase, GDP decreases, and that's when we see the changes in the chart that I just showed you. Also, we have periods of expansion. In periods of expansion, we have positive increase of gross domestic product and a natural rate of unemployment. During a recession, which is a decrease in gross domestic product, you have a negative rate of increase, which is GDP going down, and the rate of unemployment you have higher than natural. And in a period of depression, which is continuation of a decrease in gross domestic product, the rate of GDP increase is unsustainably low, and the rate of unemployment is unsustainably high. So you see that there's kind of like an inverse relationship between these two. And then the last factor last macro factor that impacts our financial thinking is currency stability. So these are currency dynamics. You have periods of inflation and periods of deflation. During periods of inflation, prices rise, which is usually the first indication that there's a period of inflation. Purchasing power decreases, and the currency value falls. And one example that I like to think of when we think about inflation is the cost of a bottle of Coca-Cola, right? I'm pretty sure that in the early 80s or 90s, we've gotten a chance to see TV shows of times back in the 50s and 60s, back when what they called soda pop was just 5 cents. And now, if you try to go and buy that same bottle of Coca-Cola, it'll cost you pretty close to $2. So what happened? We can't buy soda anymore for 5 cents a bottle, right? The price of Coca-Cola increased, and the purchasing power decreased, and our currency fell a little bit. So now it just costs more money to get that same bottle of Coke. So that's a little example that I use in my head when thinking of inflation. In periods of deflation, we see prices falling, purchasing power increases, and the currency value rises. Presumably, there's some debate over what is good and what is bad. A lot of economists don't like thinking of inflation as good or bad and deflation as good or bad because they've determined that there are pros and cons to each. For the purposes of keeping this video relatively short and on topic with the first chapter, I'm not going to go in depth about that. Perhaps that's something we can cover in the discussion area. But for example, in the research that I conducted for my dissertation, a lot of people have determined that they perceive inflation to be a bad thing. This is a chart measuring inflation from 1979 to 2006. So we see again a slight increase here between the 1979 and 1981, and then a drastic decrease. So what does that mean? During this period, for example, of deflation between 1980 and 1983, prices fell, purchasing power increased, and the currency value rose. And then up until now, 2006, we're seeing that it kind of normalizes, but it stays between somewhere between 2% and 4% around there. And I was actually, for my job, taking a look at inflation rates over the next 30 years for a project that we had going on. And inflation is not expected to go over 3 or 4%, not even in the next 19 to 30 years. So that's kind of interesting, unless there's some sort of a fad or some sort of aggregate demand or boom that causes a change in inflationary rates. In 2008, which is not listed here, 2009, 2010, the main factor influencing was the collapse of the mortgage industry. And looking forward into certain years, into future years, I hypothesize the next one is going to be with student loans. But that's my speculative thinking, looking back into history and seeing what's been going on with inflation and just the history of how people behave in the financial arena. So there are 5 steps to the financial planning process. You define your goals, assess the current situation, define the choices that you've came up with. You want to choose a plan and then assess the results. And then it's a cycle, so it continues again. If you choose further, by the way, you would assess the resulting situation, redefine the goals, identify new choices, evaluate new choices, assess the resulting situation, and so on. So you're constantly going back and forth, and when you assess your current situation, you continue to build and build and build and build until you have a solid financial plan. Goals can be identified as short-term, intermediate, or long-term. Maybe short-term, you want to buy a car. Intermediate term, I would say maybe this is you determining where you want to take your education, for example, because you know that there's a relationship between education and income, education level and income for the most part, speaking in the mean, because I'm pretty sure we've heard of stories of people with high school diplomas and college dropouts who have become millionaires, but those are, in my opinion, outliers, and doesn't happen all the time. So stay in school, everybody. And you also have long-term goals. Long-term goals. I want to buy a house. I want to put my kids through college. I want to finish paying off my house. I want to buy a condo. Multiple condos in beach resorts, that kind of thing. Long-term thinking, future. In assessing the current situation, we have to assess our sources of income, our expenses, our debt obligations, all the bills that credit cards, all that, and then also our saving potential, which comes from the discretionary income that's left over after you finish paying off all your dues. There's a couple things to keep in mind. We have to keep in mind strategic benefits and explicit benefits, and also strategic cost. implicit costs, and explicit costs as well. You want to assess the resulting situation, again, sources of income, expenses, debt obligations, and saving potential. These are a list of financial planning professionals. Some people like to do their own financial planning, such as myself, for instance. But there are also other people who can help you in planning for a solid financial plan. One of these is a CPA, which is limited to here in the U.S., a certified public accountant. Certified public accountants can usually do your taxes, at the end of the year. I have a CPA do my taxes because I feel like they're a little more familiar with the tax system, and whenever I see the word accountant, I always think of people who can assess a current situation and look at what's happened in the past up until today. Whenever I see the word financial, I think of today moving forward. So back when I used to do counseling to finance students and accounting students a couple of years ago, that's how I would explain the career paths. An accountant explains everything that's happened in the past, and someone who's in finance tries to predict the future. So that's the main differentiation between the finance people and the accountant people, in my opinion. A CPA is qualified to audit publicly in traded corporations. And as I mentioned, they can also do financial planning and tax advising, etc. If you live in Canada, which we're all in Broward, so I don't think anybody's in Canada, but they call the CPAs in Canada CAs, Chartered Accountants. In the UK, they call them CCAs, or Chartered Certified Accountants. Now we move on to the finance people. The CFA is recognized around the world. The Chartered Financial Analyst, or the CFA. It's also, by the way, it's also important to know what it takes to become one of these, so that you can understand the rigor that's involved. To be a CPA, it's determined by state, I believe, and you have to have a certain number of accounting credits in order to sit for an exam and take it, and then receive the charter. For a chartered financial analyst, there's a series of 3 exams that have to be taken. They have to have a minimum amount of work experience, and there aren't really that many CFAs. And there's a trend going on right now in the world of finance, in that a lot of banks and financial institutions are giving the CFA the same amount of weight as an MBA, or a Master of Business Administration, or a degree in finance. The reason is because it takes just as long. For the Chartered Financial Analyst, you have to take the series of 3 exams, and it's basically you order a first round of books, you study for it. Usually it takes about 6 to 8 months of study time, which is self-study time, and then you register for a test. When you pass level 1, you take level 2, same thing, 6 to 8 months of studying, you take the test. And then you take the 3rd level, and when you pass the 3rd level, then you earn the charter. And the last time I checked, there was about 100,000 CFAs in the world, which is kind of impressive, and it's a really small number considering we have about a little over 6 billion people in the world now. So what the CFA does is they work in the investment profession or in banking most of the time, and they often advise with personal wealth management. So see, looking at these are future-driven occupations. The CFP doesn't take as long as the CFA, but they're trained to assist with all aspects of the financial planning process for individuals mainly, and it's also recognized globally. The CHFC are Chartered Financial Consultants. They're trained to assist with aspects of the personal financial planning process related to life insurance. So, these are the ones that deal with, like, passing of relatives and inheritance and things like that. The CLU is the Chartered Life Underwriter. They're trained to structure and sell life insurance. So I would say these are like the behind the scenes people. An accredited financial counselor helps with financial planning, or AFC, and AEC, accredited estate counselor, specializes in disposal of assets after someone's death also. An RIA is a registered investment advisor. They advise on investment management. And I know off the top of my head, to be a RIA, you have to take a series well, you have to take actually one exam, the Series 65, for those of you who are in finance. And you also have to have a sponsor. So for some of these designations, and there are more, you have to for the most part you have to already be working for a bank that will sponsor you in pursuit of these designations. For some of them, like the CFA, it's very study driven, research driven. You can do it on your own and get the charter. But for some of them, like the RIA, you study one book and you take an exam, and then you get the designation of the RIA. And then, by the way, all these financial professionals have to register with FINRA, which is the Financial Industry Regulatory Authority, which is under the Securities Exchange Commission. So you can actually run background checks on a lot of these people. So it's good. Like if you are going to hire somebody, you want to, see their history and see who they've worked with and whatever information you can find on them to make sure that they're going to be giving you the advice that you need. And then lastly, you have an EA, which is an enrolled agent, and they advise on tax issues. An advisor's compensation is composed of a fee, a percentage, or a commission, or a combination thereof. So you just want to make sure for your purposes, at least, just making sure that if you're going to hire somebody to help you, that you can afford to pay for it, and that if you hear the same things that you already knew, I mean, I don't think it would be worthwhile to do it. Like I said, unless you have the money to spend, and you can determine, if you can afford to hire someone or not. The advisor's view can either be objective or familiar. Objective meaning they'll tell you what right off the bat what your situation is, plain black and white. And it can also be familiar to them, which in my opinion is kind of like the subjective view. They might have undergone a similar situation that you did and can give you advice on the familiar side. Now that we're wrapping up this first chapter, some of the key takeaways for the micro factors are that personal circumstances that affect financial thinking include your family structure, your health, your career choice, and your age. And I would add another category. This is off the book, but I would also say that another micro factor is unforeseen circumstance. An unforeseen circumstance is that curveball that gets thrown at us that we were not expecting, that impacts our income as well. Could be layoff, or could be something in the family, things like that. Family structure and health affect income needs and your risk tolerance. Your career choice affects your income and wealth, or your asset accumulation. The stage of life where you're at affects your sources of income, your assets accumulation, and your spending needs, as well as the risk tolerance. And sound personal financial planning is based on thorough understanding of your personal circumstances and goals. So it's important to be very thorough if you decide to hire a financial planner. Some of the key takeaways from the macro factors are that business cycles include periods of expansion and contraction, including recessions, and they're measured by the economy's productivity, which is gross domestic product. And in my research in particular, just to share with you, this is my area of research, the gross domestic product, because I feel that there is a prequel to what results in the gross domestic product. And because if consumers are not consuming, then producers are not producing, and that there's a relationship between consumers and producers. If there's no demand, if producers overproduced, then producers lose because they have high costs and high inventories. If consumers are consuming, then producers can meet that demand by producing. If consumers aren't consuming, then the producers are screwed because they're not earning any money. So in my opinion, it starts with the consumer, and there has to be a consumer demand, or what I call an aggregate demand, and that's initiated by marketing techniques, word of mouth, and a variety of other factors. And if you're interested in learning a little bit more about that, I can send you the end product of my research so you can take a look at it. An economy is an unsustainable situation when it grows too fast or too slow. As each situation causes too much stress in the economy's markets. In addition to GDP, measures of health of an economy include the rates of employment and unemployment, and also the value of the currency as measured by the Consumer Price Index, which is a measure of how much goods and services cost on average, and that's how they track inflation or deflation. Financial planning should take into account the fact that periods of inflation or deflation change the value of currency, affecting purchasing power and investment values. And personal financial planning should take into account business cycles, the changes in the economy's productivity as a whole, currency value, and other economic indicators, such as the index of consumer sentiment, which is one that, as I mentioned previously, is something that measures demand and consumers' willingness to spend money. If consumer sentiment is high, basically that means that they are more willing to spend money, which is good for the economy, and they're more willing to save less, which, although as individuals saving less is not a good thing, in our households we want to save more. Saving less and spending more is good for the economy. When consumer sentiment is down, then consumers are more willing to save and less willing to spend, which is bad for the economy because they're not initiating what needs to be initiated in order for producers to produce. In the financial planning is a recursive process, and it involves defining the goals, assessing current situation, identifying your choices, evaluating those choices, and then eventually choosing, and then continuing that cycle by evaluating that choice, redefining goals, assessing your current situation again, identifying what your choices are, evaluating those new choices, and then selecting, and then the cycle continues. Goals are shaped by current and expected circumstances, family structure, career, health, and larger economic factors or macroeconomic factors, as we mentioned. Depending on the factors shaping them, goals can either be short-term, intermediate, or long-term, and we spoke of that. Your choices will allow faster or slower progress towards goals and may digress or regress. Some goals can be eliminated, and you should always evaluate feasible choices, calculate the benefits, the explicit cost, the implicit cost, and also the strategic cost of each one. As it relates to your financial professionals, financial advisors can work as accountants, investment advisors, tax advisors, estate or insurance agents. You always should understand how your advisor is trained and how that may be related to the advice that you receive, because you may hire the wrong person. If you're trying to establish a financial plan and you really do not need any tax advice, maybe the CPA is not the way to go. You should always understand how your advisor is compensated, because you should always understand how these financial professionals are compensated, because you can recognize if they're charging a percentage, for example, of your income, then they'll probably be more apt to help people with higher incomes and not so much with people with lower incomes, for example. So then there's that element of conflict of interest that you want to take in mind when you're hiring someone to determine if you want to pursue that or not. Or you can just become very good at financial planning yourself and establish plans yourself. Lastly, you should diversify your sources of information and advice by using subjective advisors, friends and family, as well as objective professional advisors. Diversification always reduces risk. And this concludes our presentation. If you have any questions regarding Chapter 1, please feel free to